Thank you, everyone, and good morning. It's so great to see so many of you here in Paris. And on behalf of all my colleagues at Bloomberg, I'm delighted to welcome you to Disruptive Threats and Opportunities, the Future of ETFs. Of course, special thanks to our sponsor for the event, Vanguard. Without them, of course, we wouldn't be holding this event, and we'd really like to also welcome those tuning in to the live stream. So we hope you've gotten to network with some of your colleagues in the industry. Feel free to take notes as the discussions commence on stage. It's really great to see such a good turnout, actually. I know we're in the middle of summer, it's wonderful weather outside, and some of you have also traveled from quite far. I hope those of you who did travel managed to find a hotel. I was asking myself why so many of the hotels were booked up, and I thought, gosh, there must be a really amazing turnout for this ETF conference in Paris. It turns out it's Fashion Week, but anyway. So we're here today, of course, in Paris, the third leg of a 4-city series to examine the growing ETF market across Europe. Over the next hour and a half, you'll hear from leading investors, issuers, and industry experts on a range of topics such as, is industry or is indexing getting too big? Will ETFs cause the next crash? Where will the growth in new products be? And also whether MiFID regulations could unlock more transparency and growth for the industry if they haven't already. Now, as a reminder, everything said on the stage is on the record. That means you can tweet your comments, tweet your observations, photos using the hashtag Future of ETFs and hashtag Vanguard Europe. And you can follow our Twitter feed via @Bloomberg Live. Now, I'd like to introduce a special guest to the stage. Please join me in giving a very warm welcome to Vanguard Managing Director for Europe, Sean Hagerty.
Thank you, and good morning, everybody. Really appreciate the opportunity to speak with you today. Before I get to my remarks, I'm thoughtful that maybe Vanguard, an American investment management company, isn't all that familiar to the audience. So I just want to do 2 seconds on who we are. So Vanguard it was born in 1975, sponsored the first mutual fund that was indexed, and today is the second largest asset manager in the world, managing in excess of $5 trillion USD, and has now a significant presence in the European market, trying to spread our low-cost gospel to the rest of the world beyond the US. And the reason we can be low-cost, and it's important that you know about Vanguard, is that we're owned by our clients. It was an unusual setup at the time, and therefore everything we do is about how do we align our interest with our clients. And we have no profit motive. Any profit we get really goes back to the clients in the form of lower expense ratios. And so what we've been able to do is over the 40-plus years, we've been able to go from an average above 65 basis points to today globally, we charge on average on the $5 trillion we manage 11 basis points. And we see that going nowhere but down. So, and ETFs are a big part of that. So let's talk about ETFs today. Today's conference comes at a perfect time. This year marks the 25th anniversary of the birth of the first ETF. And wow, in the past, sorry about that, they've grown globally about 20% per year in the past decade. And they're really just getting started. I want to talk about an industry that I love and a product that I believe in today. And there's a lot going on in the industry right now. Usually the asset management industry moves very slowly. But today the asset management industry is moving fast. The tectonic plates are shifting underneath our feet. And it's important that everybody pays attention, because if you don't, you could find yourself falling into a crevice. The formula for success in the past, a star high-performing active manager who can command a high fee, has really changed forever. The winning firms now offer low-cost ETFs, capturing broad market exposures. 2 disruptive forces are behind this shift: the rise of indexing and the redefinition of advice. And I want to talk about both of those things. We think both of those secular shifts are really fundamentally making ETFs a preeminent product in the asset management industry. And we think that those two disruptions are going to propel ETFs even further than where they've come so far today. Let me talk about the first disruption of the rise of indexing. And I think most people mistake the rise of indexing as good, therefore it's done well. And actually our view is that its rise has largely been because of the failure of active. Specifically, active managers' failure to lower their costs in the face of a low return, low alpha environment. And I'll explain that. They have not adapted to changing markets. As you all well know, active management has always been a zero-sum game, meaning there's a winner and there's a loser. Excess return must be confiscated from somebody else. 30 years ago was a lot easier. Professional managers simply preyed on amateurs, trading on their accounts who were about 60–80% of the market 30 years ago. And what happened was the wolves were preying on the sheep, and it was easy to get alpha. Well, the sheep got smart and they hired their own managers. Today, 70–80% of the assets in the market globally are professionally managed. It's CFA against CFA, it's Bloomberg terminal against Bloomberg terminal. The zero-sum game got much tougher. And what happened is with the heightened competition, the distribution of excess returns has fallen by 60%. Unfortunately, fees have not fallen to follow suit. The average active expense ratio is still over 100 basis points in most jurisdictions. That means a successful PM must be 100 basis points smarter than every one of their peers just to equal the market, let alone beat it, a very tough task. So while many skilled active managers can find excess return, they quickly swamp it with their high fees. Their net returns sink below that of the index, making the index fund superior in net returns. So what's that mean in Europe? 90% of active equity funds and 93% of active fixed income funds in Europe have underperformed their benchmark over a 15-year period. And low-cost index funds have outperformed over 5 and 10-year periods because of that. Investors are smart and their assets have followed. Over the last decade, index assets in Europe have grown at a compound annual growth rate of 16% compared to 5% for active funds. And ETFs are fueling a large part of this growth. ETF assets across Europe have grown at about 19% compound annual growth rate over the past 10 years. Over the last 5 years, assets have doubled, and in 2017 alone, European ETFs surged 40%. And we see no sign of that abating. Rather, we think it's just getting started. To compete with the index, active managers would need to dramatically lower their fees, and we see no evidence of that happening. Adding to their advantage is market expectations. We'll be facing what will likely be a low return environment in the future. For a European investor, Vanguard's 10-year nominal return outlook for a global 60%, 40%, 60 equity, 40 fixed income balanced portfolio could be as low as 3 to 5%. We already know where the bonds are going to be. Equities are likely pretty well valued. That's compared to a historical 10-year average of around 8.5%. So a significant return, decrease in return expectation. In this kind of a low return environment, costs matter even more. So if you charge an active portfolio 1 to 2% of expected return in 1 year, that's a significant confiscation of the return that an investor is going to be getting over the next 10 years. And you have a real shortfall. It's another reason why the ETF is going to be a much better solution in the future. The second disruption is the redefinition of advice. Traditional advisors and distributors look to add value by understanding their clients' wealth goals and then setting up the most tax-efficient portfolio composed of fund managers with the promise of some level of outperformance. Compensation was driven by commissions and retrocessions, often misunderstood by the average investor. In the US, as well as several other markets, that model is rapidly changing. Post-GFC, advisors realized that active managers were too inconsistent to build their business on. And I think all distributors globally are starting to pay attention to this now. 6 years ago, Vanguard published in the US research that revealed that an advisor would be better off focusing on controlling portfolio costs with low-cost ETFs, being tax efficient, rebalancing regularly, and keeping clients from chasing returns, rather than wasting their time finding the best managers and probably making the decision to hire and fire managers at the wrong time. These simple disciplines could add as much as 300 basis points, we found, over a typical investor trying to pick the hot funds on their own. Today, technology can easily set up the proper diversified portfolio to match someone's goals, rebalance regularly, and manage it tax efficiently. Better, faster, and cheaper than what distributors have been able to do in the past. This will put even more downward pressure on fees as technology, and we'll talk about fintech later today, starts to be ubiquitous across the market. The advisor is becoming more a financial planner than a portfolio manager. We don't see that changing. We see that certainly coming to Europe. Concurrently, significant regulatory pressure in many markets is driving increased fee transparency. As a result of this, advisors are moving to fee-based advice models. Let's talk about fee-based advice models a little bit. In a fee-based model, keeping fund costs low is essential. All fees come out of one spot, the client's net return. If fund fees are high, it's hard to justify additional fees for advice. And think about what's happened in the US. In 2013, commissioned accounts were about 45% of total revenue for distributors and advisors. That number declined dramatically in 2016 to 32%, and it's expected to drop even further to 23% this year. So the rise of fee-based is coming. Of course, the transformation is happening in some markets faster than others. In those markets where a few distributors have a chokehold on the market and still insist on what we think of as conflict-laden commissions and retrocessions to pay for advice, the change will be slower. But fortunately, the regulatory trend in Europe, and we think that eventually the consumer trend in Europe, will be for better transparency, matching the fee for advice with the service provided, rather than burying the fee inside the product. We think that this move towards more transparency, this move towards more fee-based, will also propel the rise of ETFs. In closing, we've been seeing this in the US, we've been seeing it in other jurisdictions. We think it's starting to happen here. As indexing rises and the world of advice is redefined, ETFs are positioned to become the global investment vehicle of choice. ETFs are low-cost, versatile vehicles that give you diversified direct market exposure. They outperform active products. They fit well in a fee-based model. They're ideal building blocks for custom solutions, and they're just getting started. Thanks for your time today, and enjoy the rest of the conference.